In today's financial update, we've got a serious alert for UK savers, and it's something you don't want to ignore. If you've got money sitting in a savings account even as little as £3,500, HMRC could be getting ready to send you an unexpected tax bill. That's right, a growing number of people are being contacted directly by the tax authority with demands for extra payments, and many have no idea it's coming. We'll break down exactly why this is happening, how interest is being tracked, and how even modest savers are getting caught out. Make sure you stay till the end so you don't get caught off guard, and before we dive in, don't forget to subscribe to the channel for more important updates like this to help protect your money and stay one step ahead. Revenue and Customs, better known as HMRC, is becoming increasingly proactive in tracking the interest earned on your savings, and they don't need you to tell them about it. Thanks to automated systems and direct data from your bank, HMRC can now detect when your savings interest exceeds a certain threshold, and, if that happens, you could automatically receive a letter demanding payment. These letters aren't speculative, they're based on concrete financial data that banks and financial institutions report directly to HMRC, usually without you even being notified. With the 2025-26 tax year in full swing, many taxpayers are now finding themselves receiving correspondence from HMRC, not just regular updates, but actual demands to register for self-assessment or notices of underpaid tax due to savings interest. It's all part of a broader effort by the government to make sure every penny of taxable income is accounted for, and that includes the money quietly growing in your savings accounts. So how does it work? Under the UK's Personal Savings Allowance, PSA, you're allowed to earn a certain amount of interest each year without paying tax on it. For basic rate taxpayers, those earning up to £50,270, the allowance is £1,000. But once you go over that threshold, the PSA is cut in half, dropping to just £500 for higher rate taxpayers, earning between £50,271 and £125,140. And if your income exceeds £125,140, you get no allowance at all. That means every single pound of interest you earn is subject to tax at your standard income rate. Now, here's the part that's catching people off guard: the way that interest is paid can cause issues. Let's say you've deposited £3,500 into a fixed-rate savings account over 3 years at 5%. Instead of earning interest gradually each year, you'll typically receive it all at once when the account matures. In this case, that payout could be over £500 in one go, which alone could push you over your PSA if you're a higher rate taxpayer. And it doesn't stop there. Any other savings or interest you've earned from other accounts will be added to this total, potentially putting you further over the threshold. Even people on modest incomes are being hit. For example, if you put away £21,000 in a standard savings account earning 5% interest, that's £1,050 in a year, easily pushing you above the £1,000 allowance for basic rate taxpayers. And remember, the type of account matters too. While cash ISAs are tax-free, most standard savings accounts, fixed bonds, and even accounts with credit unions or investment trusts are subject to interest reporting. So even if you think you're flying under the radar, you might not be. HMRC has detailed which types of savings and investments can lead to a tax bill. These include bank and building society accounts, savings and credit union accounts, peer-to-peer lending platforms, unit trusts and investment trusts, open-ended investment companies, OEICs, trust funds and government or corporate bonds, payouts from PPI claims or life annuity payments, some life insurance contracts. So, if any of your funds are in these types of accounts, they could be contributing to your annual interest income, and if that total goes over your allowance, expect to be taxed. And the tax can bite. If you're in the higher rate tax bracket, you'll lose 40p for every £1 over your PSA. That means if you earn just £100 more in interest than your £500 allowance, you'll owe £40 in tax. The penalties scale quickly if your savings are higher or if you've got money spread across multiple interest-bearing accounts. Even more surprising for many people is that HMRC doesn't always wait for your self-assessment. If you're employed or receive a pension, they may simply adjust your tax code to collect the tax directly from your income. How do they know how much to adjust? They use the interest income reported from the previous year to estimate what you'll likely earn this year, then tweak your tax code accordingly. This has led to confusion for many people who suddenly see their take-home pay drop without understanding why. In other cases, you might get a letter asking you to complete a self-assessment form, even if you've never done one before. HMRC's message is clear: if your interest earnings push you over the line, they want their cut and they already know how much you owe. To make things even more complex, interest rates have remained relatively high recently, meaning even modest savings balances are generating more interest than usual. In the past, when rates were close to zero, hitting the PSA was a rare issue for most people. But with rates hovering around 4% 5% in many fixed and easy access accounts, your interest earnings can climb fast sometimes without you noticing. For instance, keeping £11,000 in an account paying 5% for just a year earns you £550. That's £50 above the PSA for higher rate taxpayers. And that extra £50 alone results in £20 of tax owed. Now scale that up with multiple accounts or other interest sources, and the problem snowballs. Even children's savings accounts and joint accounts can add to your total if you're listed as an account holder. So it's important to check where your name appears and whether the interest is being attributed to you for tax purposes. A common trap is assuming that because the account is for someone else, such as your child, you won't be taxed on it. If your name is on the account, it could still count against your PSA. So, what can you do to protect yourself? First, track your savings interest carefully, especially if you're using fixed-term accounts where the interest payout is lumped into a single year. You may want to stagger your savings or choose products that pay out annually rather than on maturity. Second, use tax-free savings options where possible, like cash ISAs. These allow you to earn interest without it affecting your PSA at all. And remember, ISAs are completely separate from your savings allowance, meaning even if you've maxed out your PSA, your ISA interest remains untouched by the taxman. Third, check your tax code regularly. It's easy to overlook, but changes in your code can directly impact your pay. If something looks off, get in touch with HMRC or use your online personal tax account to see what's been reported. The sooner you catch an issue, the easier it is to fix. Lastly, if you're unsure whether your income or savings qualify, speak with a tax advisor or accountant. Sometimes, small financial decisions like where you place your savings or how often you switch accounts can make a big impact on your tax bill. In a time where even modest savings can trigger unexpected tax bills, staying informed is your best defense. With HMRC now using automated systems to track savings interest and send out tax letters without warning, the importance of understanding how your money is taxed has never been greater. Don't let a simple oversight cost you hundreds. Take action now. Review your savings, understand your allowance, and make smart choices to keep more of your hard-earned money. If this video helped you get a clearer picture of what's happening with savings tax, make sure you hit subscribe and turn on the notification bell so you're always ahead of these changes. We break down complex financial topics into easy-to-understand tips so you can make informed decisions. Thanks for watching, and remember, when it comes to your money, being proactive always beats being surprised.